Chapter 9 continues on the study of inventory. So let's start by reviewing the inventory T account. There's nothing new in this account that we haven't already gone over with Chapter 8, but I want to review it because it's a nice lead-in to Exercise 2 and 5. So let's review a little bit. We know that really the main purpose of the inventory account is to track the dollar cost and also the quantity or volume of inventory. So we're going to start with beginning inventory. Purchases go in. That purchases, applies the cost principle. So we've got all these costs going in to inventory. So as we buy goods, remember all costs to acquire and get them ready for sale. So all of those costs go in, that's supposed to be cost in, to the inventory account. Now if we return any of those goods or if we get a discount on cost, that causes costs to go down or inventory account to go down. So beginning inventory plus this net amount of purchases equals our goods available for sale. And so basically either we have sold it or we haven't. So if we sell it, we're going to take the cost of the goods out of the inventory account. So cost will leave the inventory account, so they will depart. So cost out. If any of our customers bring those goods back in, again, the cost will come back in to our merchandise inventory account. So not the sales price, but the cost of the goods that have been returned. Okay, and then also I want to point out when we cost these goods, the cost of goods sold, we are applying costs at either a LIFO or a FIFO or a weighted average basis. So when we say cost, it's a LIFO cost, a FIFO cost, or a weighted average cost. So we allocate goods available for sale on a LIFO, FIFO weighted average basis to the goods sold or what's left in ending inventory. And so we have ending inventory at cost, and again, that could be a LIFO cost, that could be a FIFO cost, or that could be a weighted average cost. Okay, and then we also know that we will take a physical count of the goods at the end of the period, and so we'll have ending inventory at cost for that physical count. And if there's been theft or damage or whatever caused the shrinkage of the inventory, we'll recognize a loss, right? We'll debit some sort of loss account and credit inventory. So debit loss, credit the inventory. Okay, then there's one last thing before we actually report inventory on the financial statements. And that is to determine whether there's been a drop in the economic value of the inventory. So inventory will get reported at LCM, the lower of cost or market. And market in this case represents replacement cost. So it does not represent the selling price, what we're going to turn around and sell the goods for. It's if we were to buy those same goods again from our supplier, what would be the cost of replacing those? So replacement cost. So we will compare cost, our historical cost, with this replacement value, which we refer to as market. And if there's been a drop in economic value, we'll recognize that loss. So due to a market decline, we recognize the loss. And we do not recognize economic gains. So if we had an increase in replacement cost, we do not so I'm going to X this out. We would not recognize economic gains. So if the market price goes up, we'll leave it at cost. We don't recognize the gain. Oops, got a little mixed up there. The point I want to make is that this part right here, looking at ending inventory and comparing the cost with the replacement value or the market value, that's all going to be the focus. Here we're going to see this in Chapter 9, and especially here in Exercise 2 and 5. So the next thing I want to look at are going to be demonstrating Exercise 2 and 5, and the whole focus of those are solving for what would be reported. What's this reported value on the balance sheet, and how do we recognize the loss? So here we are in Exercise 2. Now, when we talk about replacement cost, there are really three things. We can be given this replacement cost, so that's just outright. So, and that is, here is replacement cost and that is market. But when the FASB deliberated about this issue, they put some constraints on it. So they said, okay, replacement cost should not exceed net realizable value of the inventory. It shouldn't be above that. We don't want to record it above that. So that's going to be the ceiling. So net realizable value is going to be, our estimated sales price less any cost of disposing of the goods. So, if we still have to assemble goods or whatever to get those ready for sale, and so any cost of just selling it. So our sales less disposal costs. So that's going to be a ceiling. The next one is we're going to take net realizable value and subtract out, well, what's the normal profit on that? And that would be our floor. So we have three things we're going to look at when we try to arrive at a designated market value. The replacement cost, of course, but we also want to look to see that it doesn't exceed the net realizable value and it does not go below net realizable value less a normal profit margin. So looking at the first item, item D in this problem, we're given the $120 replacement cost. We're also told the selling price is $120. Selling expenses are estimated to be $30. So that gives us this net realizable value of $90. And remember, in accounting, net realizable value means cash value. We realize things with cash. We're also given the $20 profit margin. So we take that $90 net realizable value, subtract our $20 profit margin from that, and we'll get our floor of 70. So on this first one, to arrive at market value, I'm really comparing these three, 90, 70, and 100. So 120 cannot go above 90, and it can't go below 70. Well, it's above 90, so 90 is going to be considered our market value. By the way, it's not below 70, so 70 is not a factor. So our designated market value for this item is 90. Then once we're there, now we're arriving at our ending inventory at lower cost to market. So cost is what's in our account, right? That's what's in, well, if I looked at my T account, but that's what's in our accounting system as cost for the inventory. We just saw for market value at the end of the year, so we choose the lower. So in this case, we would use cost. Cost would be the lower of the two. All right, so let's go do the next one. The next one, we have replacement cost of 72. If you go to your narrative, you're going to solve for a net realizable value of 80 this time. Subtract the $20 profit margin to get 60, to arrive at 60. And then I look at my replacement cost. It can't be above the ceiling, which it is not, but it also can't go below the 60, which it is not. So in this case, where we chose 90 there, in this case, we're going to choose the 72, which is cost. Replacement cost. So we choose replacement cost. So now I compare which is lower, $72 or 80, and we choose 72. So in the first item, we're reporting cost. In the second item, we choose market value. Okay, so then we just kind of go on and on. I'm going to go on down to H. Let's look at H. We have replacement cost of 70. It cannot go above 80, which it hasn't, and it can't go below 60, which it has not either. So we choose 70, choose $70 as our market value. And so that would go over here. And then comparing the 70 with the 50, we would choose cost of $50. Actually, I think I meant to do G. Let's do G. 65, 45, and 30. 30 can't exceed 65, which it doesn't. It can't go below 45, so 45 would be our replacement cost. 45. Compare that, then I compare the 45 with 80, and the 45 is the lower. So again, I first solve for market. Okay, that's the first thing we do. and then we're going to compare that to cost to arrive at lower of cost or market. The other shortcut I want to mention is it's really always going to be the middle of these three. So look at these three numbers. Whichever one is in the middle is going to be your lower cost of market. Let's look at item F, 65, 45, and 70. 65 is your middle number. That's going to be your market value. Let's go on down to I, 60, 40, and 30. Which number is in the middle? 40 lies in the middle, and that's going to be your market value. So extending those out. And I'll let you finish that off. That's pretty straightforward. The next thing I want to look at is exercise 5. Exercise 5 is going to build upon what we just did in exercise 2. Exercise 2 we saw for, what's going to get reported, the lower cost of market. That's the number that should be on the balance sheet. Exercise 5 helps us solve for, well, how do I make that happen? What's the journal entry going to be? Even though it doesn't ask for it in exercise 5, I think you'll find it helpful to set up T accounts and solve for things. So inventory goes up with debit, down with credits. The allowance account, there's going to be an allowance account that we will use to account for the economic loss, and then the net amount. So I want to start with, this does give us at the end of January, so January 31st, we are given an inventory balance or cost of $15,000, and we're also told the net realizable value is $14,500. So if we maintain cost in the inventory account, if we're tracking cost here, that means in order to report $14,500, we need an allowance account that's going to offset that. So a debit of $15,000 minus this credit of $500 will give us a net balance of $14,500. Now, how do I get that there? Well, let's go through and look at, down here at the bottom, our journal entry. Okay, so I've gone ahead and recorded the journal entry for us. We would have a loss due to market decline of $500, and then we would credit the allowance account. And the allowance account, you refer to your textbook, but it's something like allowance to reduce inventory to market, something to that effect. Okay, so going up here to the inventory, in February there was $20,000 of purchases. It doesn't ask for the journal entry, but we know with a perpetual system, which I'm assuming here, we would debit inventory, probably credit accounts payable. And then that gives the company $35,000 of goods available for sale. And then they give us ending inventory at the end of February. So ending inventory at the end of February at cost is $15,100, and that's all just given in the narrative of exercise 5. So we can discern then $35,000 less the $15,100, cost of goods sold must have been this $19,900. Cost of goods sold was $19,900. Now the other thing that's given in the narrative is that the lower of cost of market at the end of February is $12,600. Again, that's at the end of February. And up here we have the ending at the end of January. Here we have February 28. The net realizable value, the net value, or the lower cost of market, is $12,600. So now I can figure out, okay, this is cost over here. Here's the lower cost of market. I need an allowance account with a balance of $2,500 in it. So $15,100 minus $2,500 will give us the $12,600. And then that will back me into my journal entry for the allowance account. I need another $2,000 in that account. So we have an additional loss now for $2,000. So let's go down and make our journal entry. Okay, so I've gone ahead and just plugged that in. We'll debit the loss due to market decline and we'll credit the allowance, and so we're all finished there. Let's go back though to the prior page and fill this out. So here we can see in February we have sales revenue of $29,000 and then I'm just going to pull this from my T account, beginning inventory at cost $15,000. Let's go take a peek. 15 plus 20, goods available for sale $35,000, subtract my ending inventory to get cost of goods sold. So I'm just going to plug all of that in. 15,000 plus purchases of 20,000 gives us goods available for sale of $35,000. And then if we subtract the ending inventory of 15,100, sorry about that, 15,100, then we get our cost of goods sold of 19,900. Okay, then sales less our cost of goods sold of 19,900 will give us a gross profit of $9,100. Okay, so the point is that cost of goods sold, that expense is cost of goods sold is part of gross profit, right? We take sales less cost of goods sold to get gross profit. The other thing I like about this exercise is it's going to point out, though, that when we solve for that loss of $2,000, right, this loss of $2,000, that is not a part of cost of goods sold or gross profit. That's going to go down under other expenses or other losses. And so we will see that $2,000 reported elsewhere down below. So gain or loss due to market fluctuations of inventory. And again, that's going to be under other items on the income statement. Now let's move on to March. In March, February's ending becomes March's beginning inventory. Purchases for March were $24,000. That provided for a goods available for sale of 39,100. Then we are given ending inventory. The other thing is we're given ending inventory at the end of March is 17,000. If I know that, I can solve for cost of goods sold in this T account to be 22,100. Then the lower of cost or market, we have cost of 17,000. Lower cost or market is given to be 15,600. And again, that's at March 31st. So now I figure out, okay, we have 17,000 here. We need a net amount of 15,006. The balance in the allowance account needs to be $1,400. Now, this is not going to increase. Now we see an actual decrease in this account. It represents really just some sort of gain, doesn't it? Because if we're having to debit the allowance account, we need to credit something, and losses are debits. So we will credit something. We're not going to really report it as a gain. We'll probably report it as a recovery. Okay, so I've gone ahead and recorded the journal entry. We debit the allowance, and then we'll have a recovery of loss. And, in effect, that's somewhat of a gain, right? So we're recovering that loss, which is, in effect, a gain. So let's go back and look at, well, where is the cost of goods sold? Where is this gain going to get reported on the income statement this time? Okay, so March has sales of 35,000. Last year's ending becomes this year's beginning of inventory. So we have our 15,100. Purchases were 24,000. To arrive at goods available for sale, 39,100. And you can probably recognize I'm just really very much repeating what I would have had in the T accounts, where it was probably actually easier to do than writing it out this way. Okay, so then we get cost of goods sold, 22,100. And we take sales minus our cost of goods sold to get our gross profit, 12,900. So cost of goods sold will go in that section. And then the gain that we have, that $1,100, will go down here at the bottom of this under other gains and losses as a gain. So let's move on to April. So March is ending, becomes April's beginning. And then April had purchases of 26,500, which gives us goods available for sale of 43,500. The problem also gives us ending inventory at the end of March to be $13,000. $13,000. So that will give us, I can solve for cost of goods sold, then to be something like 30,500. So we have ending inventory at 13. We are told the lower cost of market at the end of April is 12,300. So at the end of April, 12,300. So we would need a balance in the allowance account to be $700. Once we know that, we can solve for, well, then we need a credit. And again, that's going to be some sort of gain. So let's go to the next page and record our $700. Okay, so we have our debit to the allowance, recovery of loss. Oops, I made a mistake there, didn't I? That was supposed to be $700. Okay, and there I've made that correction for 700. Let's go back and then look at, for April, how that would all look over here. So we have sales of $40,000. Again, last month's ending is this month's beginning, so $17,000. And then we had purchases, 26,500. For goods available for sale, 43,500. We can subtract our ending inventory of 13,000 to give us cost of goods sold of 30,500. We take sales, subtract our cost of goods sold, and that will give us our gross profit, $9,500. So again, sales of sales of 40,000 minus our 30,500 gives us a gross profit of 9,500, and then we had a recovery of loss, which in essence is a gain of $700. So that in its essence, between those two exercises, we see how to solve for lower cost of market, how the gain or loss gets reported, and also what would those journal entries, what would the journal entries look like. And then the last thing I want to talk about is this section in your textbook. Mine's on page 481, but evaluation of the lower cost of market rule, because this has some interesting theoretical concepts that are important for you to understand. The first one states that the company recognizes decreases in the decreases in the value of the asset and the charged expense in the period in which the loss in utility occurs, not the period of sale. So we don't have to wait until the goods are sold to recognize the expense. We recognize the economic loss when it takes place. Secondly, application of the rule results in inconsistency, because a company may report inventory at cost one year and market at the other. So there's an inconsistency in reporting. So that violates the consistency principle. Number 3, which is okay, because sometimes, again, the FASB recognized it was going to violate that, but felt that the relevance of the information overweighed that. Number 3, lower cost of market values the inventory on the balance sheet conservatively, but the effects on the income statement may not be. So for instance, recall when at the end of exercise 5 we had those gains or the recovery of losses. So it may actually inadvertently cause profits to increase because of using this method. So just recognizing that is one of the pros and cons of this method. And number 4, application of the lower cost of market rule uses a normal profit in determining inventory values. Since companies estimate normal profit based on past experiences, this can be subjective. So, it's a subjective measure, which anything that's subjective can be susceptible to income manipulation. So I just want to point out, I've got it written over here, but again, the 2 key qualitative characteristics back in Chapter 2 about reporting information on the financial statements. The information needs to be relevant and it needs to be reliable, or now the term is representational faithfulness. So that representational, if I can get that on there, I don't know if I'm going to get it on there, representational faithfulness, which is just a more sophisticated way of actually saying reliable. So the information needs to be relevant. It makes a difference to the reader in their decision, and the information needs to be representational faithful. It means we need to be able to rely on the information. So those 2 keys are why it was very important. So we know that market value certainly is very relevant to the reader, but cost is a more reliable number. So when we use the lower cost of market, we often are choosing relevance over representational faithfulness.